So there are lots of numbers involved with mortgage financing. I'm a numbers geek, not everybody is. And so when we're explaining mortgage financing and breaking this down, I call this Mortgage 101. Really, there are lots of numbers with regard to mortgage financing. What it really boils down to, there are two main numbers that you have to be aware of at all points in time when you're financing a home. The first number I'm going to refer to as your PITI payment, P-I-T-I payment. This is the total monthly mortgage payment that you have to make when you have a mortgage. And what I mean by that, what this consists of, first and foremost, is principal and interest on the loan, just like any other loan you've ever had before in your life. Then we're going to collect each month with your monthly payment property taxes. We're going to collect 1/12 of the total annualized property taxes on that house. We're also going to add in insurance, what's known as homeowners insurance, hazard insurance, some people call it fire insurance. And this is, again, we're going to collect 1/12 of the annual premium on that insurance policy. So PITI payment, P-I-T-I, stands for principal, interest, taxes, and insurance. Easy enough. Now, the reason I like to go over this is because all too often people come into my office and they might have done some online research first and entered some numbers into a mortgage calculator. All too often those mortgage calculators just spit out the principal and interest on the loan and do not include the taxes and the insurance. A lot of times those mortgage calculators online are designed by real estate companies, real estate agents, and they want to make sure it looks real affordable for you to purchase this new home, and so therefore you pick up the phone and give them a call to say, let's go see it. When what you're concerned with regard to the financing is this PITI payment. That's what I'm concerned with as well when I'm qualifying you for the loan. So principal, interest, taxes, and insurance. The collection of the taxes and the insurances go into what's called an escrow account. An escrow account is just, I think of it like a side pot of money. We're collecting a little bit of your money each month. We're going to accumulate that in this escrow account. And then at the end of when the next tax bill is due or when the next insurance bill is due, that's when we're going to take money out of that escrow account and pay those taxes or pay those bills for you. So that's the first part of Mortgage 101. Second part, and the second number that you need to be aware of at all points in time, is what I'm going to refer to as your cash to close. And this is the total out of your pocket that you will need to have available to buy this next house. All too often, this number gets confused with what's more commonly referred to as down payment. A lot of times people come into my office and they'll say, hey Dave, I have $10,000 to put down on a house. And I say, great. When I add up some numbers, the cash to close becomes $20,000 or $25,000. And that's when the blood drains out of their face and they look at me and they're like, no, Dave, I don't have $20,000 or $25,000. I have $10,000. What they said to me was, I have $10,000 to put down. What they meant was, I have $10,000 all in. That's the final figure that I have. That's the cash to close. Down payment is simply what you're putting towards the actual purchase of a home. To make my math easy, if you bought a $100,000 house and you put $10,000 down, you're going to need a $90,000 loan. But it also costs money to borrow money. This is what are called closing costs. Most people are familiar with this term. Closing costs are things like appraisal fees, credit reports, title insurance, transfer tax. The list goes on and on. This is where all the numbers come in. Then, in addition to closing costs, we need to add something in called prepaids and reserve requirements. Now, not everybody is familiar with this term, and not every lender separates these out. Oftentimes these get lumped into closing costs, but they're not necessarily closing costs. To explain this further, the best way to do this is all about property taxes on the house as well. The easiest way for me to explain that is to take a calendar year, or take a timeline. Say January 1 to December 31st. In the state of Pennsylvania, property taxes come due twice a year. The first tax bill is what I'm going to refer to as the spring tax bill. It's the little one. It's roughly about 30% of the total taxes due on a property in a given year. These taxes are paid on a calendar year basis, so they're paid from January 1st to December 31st. Easy enough. The big bill comes due on July 1st, and that's your school tax bill. In the state of Pennsylvania, when you own a home, you pay for all the kiddos to go to school, you pay for all the teachers to teach them. This bill is paid on what's called a fiscal year basis. So it's paid, the school tax bill is paid from July 1st of the current year through June 30th of the following year. It follows the school calendar year. Now, if we were to buy a home, let's say today, the day that I'm recording this video, which is 9/25. If we were to buy a home today, okay, the first thing I'm going to tell you is the government in Pennsylvania does not trust you very much when it comes to the payment of property taxes. And what I mean by that is the government won't let you buy a home today, live in it for a year, and at the end of the year, pay them for the taxes that you owed while you live there. The government wants paid up front. So if we were to buy a house today, you can see that the seller would have paid that spring tax bill on January 1st, 2024 in this case, good to the end of the year. The seller's going to look at you at the settlement table and say, well, you've now bought the house. I want reimbursed for that amount of the taxes that I have prepaid for that. Same thing with the school tax bill. On July 1st, they paid the school tax bill good through June 30th, 2025. They're going to want reimbursed for that amount of the school taxes that they have prepaid, if that makes sense. Now, the next thing we have to do is go over this reserve requirements. And reserve requirements are basically what we're going to be pre-funding into the escrow account so that next year you have enough money in that escrow account to pay those taxes when they come due. For example, if we were to buy a house on September 25th, and this is not drawn to scale, of course, but your first payment will be due on November 1, okay? So if we're making pity payments, right, where we're collecting taxes and insurance with your monthly payment, and that first payment is due November 1, you're gonna make a November payment, a December payment, and a January payment. You're gonna make 3 payments before next year's spring tax bill comes due again. That means if we've made 3 payments, we've collected 3/12 or 1/4 of your total amount of taxes. 1/4 is, of course, 25%. Keep in mind that spring tax bill is roughly 30%. We'd be a little bit short. We wouldn't have enough money come January 1st to make that tax payment from your escrow account. So reserve requirements are what we're going to pre-fund into that escrow account to make sure that happens and you don't have a nasty tax bill come due right after you've just purchased your new home. So when we add up the down payment plus closing costs plus prepaids and reserve requirements, we get what's called your cash to close. One of the ways we can manage your cash to close to being something that might be a little bit more affordable for you is by asking, or subtracting out here, asking the seller for help. We can ask the seller to cover some of these costs for you. Now that may or may not be available, and you'd have to ask your real estate agent and negotiate that with the seller, but that's certainly a tool that can be used. The last thing I always go over with mortgage financing is what I call the magic number. The magic number is a 20% down payment. If you put 20% down, we as lenders, whether it's us or any other lender out there, feel very warm and fuzzy about lending you money. And the reason being is because you're putting real skin in the game. We also know as lenders that if you were to default on the loan, which we don't ever want to do, we want to set you up for success. But if you would, we have enough equity in that property that we as lenders would not lose our original investment in you or the loan. For example, if we make my math easy, if we're buying a $100,000 house and you put 20% down, you're only asking for an $80,000 loan. In this case, if you defaulted and the market softened a little bit and we could not sell that house in foreclosure at $100,000, if we could only sell it for 90, would we get our 80 grand back? Yes, we would. If we had to, we could probably dump that house on the market at 80 grand and get our 80 grand back. So we feel very warm and fuzzy about lending you money with that. Now, not everybody has 20% to put down. So if we don't, that's perfectly okay. We've got plenty of products out there to help you out and still buy a home. But if you don't, we have to add something on this side of the equation into the pity payment called PMI, Private Mortgage Insurance. This is like gap insurance when you buy a new car. It's basically gap insurance for a mortgage. And all this does is insures the lender that we would get made whole in the event you defaulted. So for example, going back to my $100,000 example, if you purchased $100,000 and we lent you $100,000 and you defaulted on the loan, let's say the market softened, the house was then only worth $90,000, we'd be $10,000 upside down. We don't ever want to be upside down, we don't want to be in that position, but that PMI at that point in time would come make us whole after a foreclosure sale. Guys, this is how easy mortgage financing is. Whenever you're looking at a lender and looking at some options, the two key numbers to make sure you're paying attention to are pity payment and cash to close. So give me a call. I'd be happy to walk you through this. I'll walk you through this again when you get to my office. But this should help you, or hopefully this helped you to get a little bit more familiar with some of the terminology that you're going to see when you're applying for your next mortgage.